So guys, welcome back. I hope you enjoy the holiday season and a Merry Christmas to you. Today, we're going to talk about key concepts. The first subject that we are going to talk about is trading terminologies. 1 basis point is 1/100th of 1%, or 0.01% or 0.0001. A spread is the difference between the ask and the bid price. If the bid is 10.9050 and the ask is 10.9055, so the spread is 5 basis points or 0.0005. What is short selling? It is selling a stock and waiting for its price to depreciate to make a profit. Longing is the opposite of this. It is buying a stock and you're waiting for its price to increase in order to make a profit. Let's assume that we have opened our brokerage account and we would like to trade XYZ stock. So a retail trader buys the bid and sells the ask. So let's assume a buying scenario at this current price. We can see that the ask is right now 10.9055, right? So when we would like to open a position, this price will be fixed on us. However, we will be buying at this rate. Our calculation will be based on the bid. In order to make it a bit more clear, so I'm going to give you an example. Let's assume that we buy at 10.9055. Let's assume that we buy at 10.9055, which is the ask rate. Your current P&L or profit and loss is calculated on the current bid, i.e. 10.9050. So what this is the spread that we're paying. This is the price that we're paying for the market maker, excuse me. So in order to make a profit, the ask should increase to 10.9061 in order for us to make 1 basis point profit, because the spread is 5 basis points. So in order to demonstrate this a bit better and help you understand, we said that we bought at 10.9055, right? So at that time, the bid price was 10.9050. Right now, let's assume that our XYZ stock will be going up. In this stage, we can see that when the ask price becomes 56, the bid will become 51. And remember that we bought at 55, right? At which time the bid was 50. So what we would like to see is that the ask price to increase. So when it becomes 59, the bid price becomes 54. Until this moment, we're 1 basis point down. So let's assume that the price keeps going up. So at 10.9061, our bid will be 10.9056. And here we've made 1 basis point profit. So the more the ask price increases, so does the bid, and this is when we make a profit. So when we buy the ask. However, our profit is calculated based on the bid price. The inverse of this is right for professional investors and at investment banks and hedge funds, which have direct access to the trading floor. They buy the ask and short the bid. This is a bit confusing and you need to practice it a bit more, but this is how a retail trader's profit and loss is calculated. A margin account, it's an account where you deposit a certain margin. Let's assume that you deposit $1,000, right? So when you're trading on your margin, and usually the margin account can be leveraged. What leverage is, it is to increase the size of your position by an X amount. So you can leverage your position 2 times, 3 times, 4 times, 5 times, and etc. And that depends on your brokerage account and your broker and their policies. So basically, when you trade on margin and you leverage, you increase the risk. So when you trade on margin, you increase your risks, because if you call the position in the right direction, you're going to be making multiples of your original margin. So let's assume that you need $1,000 in order to open a position, but you already have $200 in your margin. What you can do to open that position, you can leverage your initial margins 200 by 5 times, which will become the $1,000 necessary for you to open that certain position. This is the concept of margin and leverage. A growth stock is usually considered those stocks whose earnings are higher than the average in the past and are expected to perform this way in the future. A value stock, on the other hand, have a strong balance sheet and higher dividends. I encourage you to read more about growth and value stocks, because I cannot share all the necessary informations with you at the moment in this short video. However, the basic concept is that growth stocks have earning per shares that are beating the average in the past, and they keep giving good results. However, value stocks are not considered based on the earning per share. Traders usually focus on the balance sheet and higher dividend yields of the stocks. So please go on Google and other free resources and read more about growth and value stocks in your own time. Market capitalization is the total of the shares available multiplied by the current price. So we have different categorizations when it comes to market cap. So we have large cap stocks. Their volume is $5 billion or more. So it is like we said, it is the total shares multiplies the current price. If the result is 5 billion or more, this stock is called a large cap stock. A medium cap stock is a stock which has 1 to 5 billion. The market share of it equals to 1 to 5 billion. A small cap stock is a stock that is less than 1 billion, and a micro is less than $50 million. So when it comes to fundamental analysis, there are two schools of thought. One is a top-down approach and the other is a bottom-up approach. So I personally use a top-down approach, and this includes studying the market as a whole first. So you would like to look at the economy overall, how the economy is working and what current stage is it in. Then you delve down deeper into industries and sectors within a certain economy. Then we would like to know which industries are growing and which sectors inside those industries are growing and which one are depreciating or losing value or are at a loss. Then we delve even deeper and pick stocks inside the industries that are growing, which we think that grows, and the stocks that are underperforming, so that we can long the stocks that are outperforming and short the stocks that are underperforming. And our aim in this is to beat the market returns, because if you go and buy the sector, we can get, for example, 10% return annually. However, if we know how to pick the right stocks, we can generate a further and greater profit. And bottom up is the exact opposite of this. So in a bottom up approach, you first look at the stocks, then you go into the industries, and then you look at the economy. So when it's come to a business cycle, we would like to know what a business cycle is. The market grows in cycles. We have expansions and contractions. So an expansion is when the market is going up. And basically what by the market we mean, one of the leading indicators of the market, which leads the market, is GDP. So when GDP grows, the market goes up. And when GDP doesn't grow, the market contracts, right? So an expansion in the business cycle, which in other terms mean increase in GDP quarter over quarter. And a contraction is a decrease in GDP or a bear market, where the stock market contracts and moves down. What we have in order to perform our fundamental analysis are economic indicators. These indicators indicate the movement of the economy. The first indicator, and the best one, which are used by professional investors, is the leading indicators. So the leading indicators predict the movement of the economy in the next 6 to 12 months. Professional traders look at leading indicators, interpret the results correctly so that they can predict the movement of the economy in the next 6 to 12 months. That is how they make their money. On the other hand, we have coincident indicators. These indicators reflect the current state of the economy. So professional investors or professional traders use coincident indicators to confirm their views. So first they study the leading indicators and they predict the economy. 6 months down the line, they look at coincident indicators to see whether their views were right or wrong. So let's say a professional investor looks at the leading indicator and he generates a view where he thinks that the economy will grow in the next 6 months. Coincident indicators will confirm this view 6 months down the line. And this is the correct way to use coincident indicators. Professional investors or traders never use coincident indicators in order to trade. The other thing that we have is lagging indicators. So these reflect conditions that has already happened in the economy. For example, unemployment rate. And this is something that retail traders that are not correctly educated, that they trade on. And TV news usually make a big deal out of this, but this is actually very wrong to trade on, because this is a lagging indicator, for example, the unemployment rate, because it's something that has already happened in the past. Professional investors would like to read the future, to know where the future is going, where the market is going in the future. It is wrong to trade based on something that has already happened, because you're already late to the party and other professional investors have already taken their positions 6 to 12 months prior to this news that has just came out, and they made their profit. And when a retail trader trades based on lagging indicators, they provide liquidity for professional investors to get out of their positions, which they saw 6 or 12 months prior to this. We also have, when it comes to return, we have beta. Beta is the stock price volatility based solely on the market movement. So the US stock market has a beta of 1. Let's assume that there's a stock that has also a beta of 1. These are information that is publicly available, and you can go on, for example, Yahoo Finance and find more about beta. So let's assume X stock have a beta of 1. What this means is that if the US stock market moves 10% up, this stock will also move 10% up. So it reflects the movement of the stock market. But let's assume that we have another stock that has a beta of 1.5. This means that this stock is more volatile than the stock market itself. So if the stock market moves 1 point up, this stock will move 1.5 points up. And if the stock market comes down 1 point, this stock will also come down 1.5 points. So what you'd like to do in a perfect scenario, in an ideal scenario, you'd like to choose correctly the stocks that will grow and have a higher beta. This way, when the stock markets go up, your returns will be higher. However, this is associated with risks, and you need to know how to manage the risk correctly so that your downside is protected and these high betas doesn't hurt your portfolio. Lastly, every professional trader would like to generate alpha. What alpha is, it is a return that's higher than the market. So we have already talked about that the market have a beta of 1, and if the market moves up, let's say 10%, an alpha would be a profit of 20% or 30% or 15%. So when a trader talks about generating alpha, alpha is a return which is higher than the return of the stock market. And this is what every professional trader is going after. So guys, thank you very much for being with me in this video. I hope these terms have clarified some essential information to you. I have personally struggled when I started out with these terms because I didn't understand the correct interpretation of them, and I didn't know what these terms meant, and that is why it took a lot of time for me in order to get comfortable with them. However, I encourage you that you go onto Google and research more terms and get comfortable with other terminologies that are used by traders, because in the subsequent videos you're going to be mentioning a lot of the things that we have just mentioned here, and particularly you need to understand how a trading platform or a brokerage platform works and what it means to look at the ask and the bid price and know how your profit and loss is calculated and what side of the trade you're being on. So again, thank you very much for being with me today, and in the next lesson we're going to talk about a bear and a bull market, and we'll identify how a bear market is calculated and how a bull market is calculated, and how can we take advantage of these different markets. Your feedback matters a lot to me. I hope that you ask your questions in the comment section, and if you like these videos, please share some love and like them and share them among your friends so that they can benefit as well. Again, thank you very much, and looking forward to seeing you in the next video.